dos, uno.
Good morning, everybody. Today we will make a presentation of the EMBI. This provides us with information of debt instrument used by governments and banks. This project has been doing to study the returns of USA stocks and the EMBI. Next slide, please.
About country risk, we have some definition about from Stockbout in 1969, also emphasized about country risk, indicating that the country risk is represented as the investment climate, in the opinion of a foreign investor. For a country, it is important to have a low country risk, since this is an index that the country is in a good condition so that a foreign investor can make investment within that country, which expects better returns with a low risk. Additionally, we have three types of country risk. First is the political risk. This type of risk, the government has political application, where investors cannot distribute their capital, interest, dividends, or profits to their countries. These political applications are based on the political stability, political regime, and the level of corruption. The second type of risk is sovereign risk. This type of risk is when the debtor is the government, where one of the possible causes that the government does not pay its debts is that there are economic problems inside the country. On the other hand, the country risk with the excess risk are also usually considered as equivalent. And the third is transferring risk. This type of risk is based on the fact that the debtor is a private entity, being that this entity cannot pay its debt, since it cannot access to currencies in which its debt is located. In general, this situation occurs when a country makes the decision to restrict or limit the entry of some currencies. The next, please.
Well, so we have a lot of factors that affecting the country risk. We have three. The first of them is the economic factors. We have mentioned the level of fiscal deficit. It could be between the income and expenses. The GDP growth. A large government deficit with respect to the GDP generates the need to greater debt issues, which entails a higher interest rate. That's important to mention the GDP growth. Also, we have the income debt ratio and the consistency of macroeconomic policies. We have other factor that is the social factors. What about the social factors? We have the political turmoil and the political pressures on public spending. The attitude of citizens and political and social movements can be a risk factor for the country. So that's the reason why we mention it. And also the final factor is the institutional factor. We can mention the strength and credibility of the institutions. And we can mention there the high levels of corruption. That is really important in these factors. The corruption are generally associated with a large bureaucracy, and that generates an uncertainty due to the need to carry out unexpected procedures and incur in higher costs than they didn't expect. We also have legal and tax stability and the public security. Next slide, please. Well, how calculate the country risk? A conventional way of measuring of country risk is to compare the price of a zero coupon bond from a risk issuer against the price of risk-free bond, provided that both have the same term and pay the coupon in the same term. What is assumed here is that price difference between the risk-free bond and the risk bond shows the present value of the cost of default. This implies that the highest return on the risk bond is the compensation for the existence of a probability of a default. Next slide, please.
Okay, now I'm talking about EMBI, the definition, what is good for types. And next slide. Okay, what is the definition? It is the main benchmark index to measure the total return on international government bond issues by emerging markets countries that are considered sovereign and that comply a specific liquidity and structure requirement. Who invented? It was created by the international firm JP Morgan Chase, and which daily monitor our debt instrument in dollar issued by different entities. For example, government, banks, and companies. And thus conceiving these indices become a benchmark useful for investors. How is calculated? It's calculated so the difference in the interest rate paid by dollar-denominated bond issues by emerging countries and the United States Treasury bonds. Next slide, please. So what is good for, how can we use EMBI? Who uses EMBI? Its objective is to provide investors with reference elements to evaluate the performance and analyze the returns and risk of sovereign bonds denominated in the United States dollar and with outside-in value calculated and least $500 million. Who use EMBI? Those who use the countries that currently make up the index are Brazil, Bulgaria, Chile, China, and others countries. Next slide.
I'm going to talk about the EMBI types. The first one is the Emerging Market Bond Index, which is an index that allows to measure the difference between the interest rate that a country must pay because they emit international debt with respect to the credit that the US bond pays. These US bonds are considered free of risk, and those riskier bonds have to pay a higher interest. For being part of this index, the debt must be more than 500 million and comply with the commerce requirements. The other type is the EMBI Plus that was introduced as an extension or actualization of EMBI. And this is also include the same way of calculation, that is the difference of rates. And this indicator is used like a thermometer that measures the health state of an economy. Next slide, please.
Okay, the last type is EMBI Global. The global EMBI has been calculated since 1999 with a total of 117 instruments used by 31 emerging countries and admitting federal liquid instrument. So the EMBI Global Index includes countries highly qualified based on the levels of per capita income defined by the World Bank, and the countries track recurring the restructuring debt. Next slide, please.
The EMBI calculation. As mentioned above, the spread or swap are calculated in basis points, while higher is the difference between the rates is riskier the inversion, due to the risk perceived by the investor increase. We have here an example of how was evaluated the situation in Peru in September of 2016. Peru was the country with less risk based on the EMBI. As we can see, Peru has 1.62%, which means 162 basis points, comparing to Venezuela that has 23.16%, that is 2,316 basis points. which is a lot of difference comparing to Peru. Next slide, please.
Okay, I'm going to talk about first the Peruvian economy. Then I'm talk about the EMBI Peru. Okay, the next slide, please. Okay, first, the Peruvian economy has experienced two distinct phases of the economy development since the beginning of the new century. Okay, between the 202 and 214, Peru was one of the fastest growing countries in Latin America, with average GDP growth rate of 6.1% per year. Prudent macroeconomics policy and far-reaching structural reforms in the framework of favorable external environment generate a state of high growth and low inflation. Can you see in the graphic, okay, at the 215, and 219 about the inflation, about the PIG. Between the 214 and 2019, GDP growth was slower, okay, slower, and the average rate of 3.1% per year. Largely due to fall in the international price of raw materials, including copper, the first export product from the country. This led to a temporary reduction in the private investments, lower tax collection, and a slowdown in consumption. Two factors mitigate impact to this extended shock GDP, which allowed the economy to continue growing amid the slower pace. We enough international reserve for an orderly adjustment of the exchange rate. The second factor was the increase of the mining production as the projects launched in the previous years mature, which led to increase in export and offer a slowdown domestic demand. Next slide, please. Okay, in this slide, I'm going to talk about the EMBI Peru and 10 years. Let's go. Peru is per se is a one-off country, a region with the lowest rates on defaulting debts. Despite the global crisis of COVID-19, it remained on the stable position, unlike neighborhood countries. Despite the fact that the economy performed poorly in the first semester and growth expectation for the year moderate, Peru's risk indicator tend to decline. The country risk measured by the EMBI Peru stopped at 90 basis points in 2019, its lowest historical level. The EMBI measure is the extra cost a Peruvian bond must pay against the yield offered by bonds issued by the U.S. Treasury. The cost of 5 years credit default swaps, CDS, for Peru dealt 250 points, also a record now, is also a record low too. And the CDS measures the cost of the insured Peruvian debt in the event of the default. The reduction in this indication reflects on the hand that Peru goods a macroeconomic fundamental in the context in which the central banks of the main development economy have announced expansionary and monetary policy, interest rate reduction. Investors are eager for better return and emerging markets such as Peru. Next slide, please. Okay, this is about now, the actually of the Peru, the situation, the rates, the country risk, the both internal economy and external economy. And now is the favorable for our country, okay, Peru with 1.16% points reported for the lowest country risk in the region around the neighborhood countries, according to the investment man, the JP Morgan. Okay, next slide, please.
So now we are going to talk about comparison with EMBI in other countries, specifically related to Chile, Colombia, and Mexico. So in July 2020, according to information provided by JP Morgan, Peru was the Latin American economy with the lowest financial risk and return rates with around 172, as you can see here. On the other hand, Venezuela was the economy with the highest financial risk and return rates, with more than 30,700. In the graph, it is observed that with respect to Chile, Colombia, and Mexico, the country risk is the lower in that order. Likewise, the following graph shows the most important problems affecting Latin American countries according to opinion leaders and journalists in 2019. The top 5 are corruption, unemployment, and the lack of economic growth, political instability and institutional weaknesses, security, crime, and drug trafficking, and nowadays coronavirus too. In addition, the next graph shows the country risk of the 4 countries from 2017 to October 2020. As you can see here, the highest risk indicator corresponds to Mexico. The orange lines followed by Colombia. The green line throughout the period, the whole period, while since May 2019, Peru has remained constant with the lowest risk indicator of the period, as you can see here, since May 2018, the blue sky line. And what about Mexico? Here we can see the highest and lowest rates since 1999 until March 2020. For instance, the worldwide crisis in 2008 and recently the coronavirus. And here, another one related to 2018 until 2020. For instance, Trump taxes and in 2019 and Pemex recently, which is a governmental company of oil. And what about Chile and Colombia? As we can see in the previous graph, Chile had a lower financial risk and return rate than Peru. Chile has been one of the Latin American economies with the highest growth in recent decades because of a solid economic framework. However, there is an increase in public debt and the balance of risk is projected to decline as a consequence of the uncertainty due to the impact of COVID, coronavirus, and the instability of the internal political context, as you can see here. And about Colombia, Colombia has a history of prudent fiscal and macroeconomic management based on an inflation targeting regime, a flexible exchange rate, and rules-based fiscal framework. However, Colombia continues to be one of the Latin American economies with the highest income inequality and informality in the labor market. And additionally, the current pandemic has significantly hit the economy and caused a very deep recession. So that is the current scenario of both countries.
To conclude, JP Morgan created EMBA, emerging market bonds. They serve as risk indicator of sovereign bonds of emerging countries. There are 3 types of MBI. MBI, difference between the interest rate of the international bonds of the emerging country and the interest rate of the EMBI. Additional EMBI Plus, which includes Eurobonds and dollar-denominated bonds in its calculation. On the other hand, we have EMBA Global, which selects countries according to per capita income. Additional, Peru is currently considered to have the lowest country risk in the entire region. So in 2019, it achieves 90 basis points, which suggests to foreign investors see a Peru as a country of investment that generate high returns. In comparison with Chile, Colombia, and Mexico, based on this data provided by the Central Bank of Peru, we can infer that Peru maintains a risk indicator below the other countries mentioned. On the other hand, it shows Mexico with a high indicator risk. Her hand email Lamont in 2017 in the article recommends that a country must have a low rate of corruption, political problems, tax fraud. Likewise, the emerging country must have a good reputation in the world to have a show low risk country. Thank you.